Imagine going for an accounts receivable interview and the interviewer asks, how do you measure AR performance? And you sit there thinking. At the time, if you don't know this answer, you are already in trouble. But don't worry, in this video, I am going to break down the top KPIs used in accounts receivable in the simplest way possible. Just clear concepts that you can understand, remember, and confidently answer in interviews. By the end of this video, you will not only know the KPIs, but you will also understand what they actually mean in real life, something most candidates miss. So let's get started. Let's take up the basic question. What are KPIs in AR? KPIs or key performance indicators are metrics that companies use to measure how efficiently they are collecting money from customers. In simple words, are we getting paid on time or not? Now, let's jump into the most important KPIs you must know. The first and most important KPI is the Days Sales Outstanding, also called DSO. It tells you the average number of days a company takes to collect payment after a sale. The formula for DSO is accounts receivable divided by credit sales multiplied by number of days. For example, if your DSO is 60 days, it means customers are taking 60 days to pay. Lower DSO means better cash flow, and higher DSO means there is a problem in collections. Now let's look into the next KPI, Aging Report, one of the most used tools in AR. It classifies receivables into buckets like 0 to 30 days, 31 to 60 days, 61 to 90 days, and then 90 plus days. Why it matters? It helps identify which customers are delaying payments. If most invoices are in 90 plus days, it's a red flag. With this report, you actually understand that which are your customers who are paying you fast and which are your customers who are delaying the payments. Let's now look into the next KPI, Collection Effectiveness Index, which is called as CEI in short. This sounds complex, but it's actually powerful. CEI measures how effective your collection team is. It compares what you collected versus what you should have collected. Higher CEI means better performance. A CEI close to 100% means excellent collections. Then we look at the accounts receivable turnover ratio, that is AR turnover ratio. It shows how many times a company collects its receivables in a year. The formula for AR turnover ratio is net credit sales divided by average accounts receivable. Higher ratio means faster collections. Now let's look into the next KPI, that is bad debt ratio. This KPI tells you how much money you are not able to collect at all. It shows the percentage of receivables that become bad debts. Credit control. The next KPI we look at here is average collection period. This is closely related to DSO. It tells the average time taken to collect payments. Lower period implies faster cash inflow. Companies always aim to reduce this number. We have just now gone through the basic KPIs that any company should monitor. When you are in an interview, the interviewer might ask you questions like, which KPIs do you track in AR? You can confidently say, I track KPIs like DSO, aging analysis, CEI, AR turnover ratio, bad debt ratio, and average collection period to monitor collection efficiency and cash flow. If you are able to explain all the KPIs that you are managing in your organization, the interviewer will definitely have a good impression about you. So with this, We have briefly gone through all the KPIs today. If you found this video helpful, don't forget to like, share and subscribe for more accounting and finance interview content. Thanks for watching.